Good day, fellow investors. So in the last videos with the quick takes on stocks, we discussed Shell, Unilever, Diageo, and many of you commented how you really liked the Carlin value investing quadrant. So I thought in this video I'll discuss it a little bit more and then also add 10 businesses that we have discussed in our previous videos. So over the last 2 months, we do a lot of stock analysis when I look at it alongside other educational investing videos, so subscribe to get more of that. So we'll discuss 10 stocks today. I hope you enjoyed. I hope you enjoy the quadrant and that we get value from this. Both me from the research perspective and side, and both you from investing ideas and education. For the research platform subscribers, I will test this more in detail and then also put more specifics into the risk and reward for our investing on the research platform. Because I have to be very careful on the risk and reward. So it will take a little bit of time, but I'll likely make it in the next week or two. Now, what's the name of the game here? The core of value investing is that an investment is good when the risk is very low and the reward is high. That is value investing at its best. The efficient market hypothesis says that high risk equals high reward, and that's something we as value investors disagree strongly with. We think that actually when you find something that is low risk or very little risk, the only thing left is upside and therefore high reward. Let's immediately start with a recently discussed stock. So we discussed Rio Tinto. Let's put it into perspective. So you can see here the commodity cycles, super cycles, good times, very bad times, then going into good times, and these cycles last between 5 and 7 years. In the meantime, Rio Tinto compounds as there is more demand for iron ore, for the products there, so they just do their business, and now the P/E ratio is 10 and the dividend yield is 6%, which is not bad. But with these cyclicals, it's better to buy them when they have no profit, when they look bad, and when it all looks like the world is going to end. Now, there are still so much expectations about commodity cycles, etc. But nevertheless, this is about what, 110 billion US dollars. This is the Australian stock here. So let's say I think that Rio Tinto can make 10 billion per year on average, more likely 8, 5, 4 in a bad year. So the P ratio long-term cyclical average should be around 10, which means that the reward is already long-term a little bit higher than the market. But when it comes to risk, if there is a recession, you can get it a lot cheaper. So the reward is there, but also, let's say, the risk is there. Of course, this is just for indicative purposes, no precise calculations, but that's what YouTube is for. So I would put on better than the market reward for Rio Tinto and also higher than the market risk because of its cyclicality. Now, the next stock is Altria. So tobacco, many of you commented when we discussed it that dividend yield is there, and even if the business remains stable for the foreseeable future, the dividend should give a great return of 8.5%. However, I would argue that the sector is in declining and they can protect that dividend not forever, plus increasing debt, high debt levels, and whatever they are doing, it's more financial engineering. So I would definitely put Altria in the higher risk group. And what happens if the dividend, it's finite cash flows? So also I think long-term, given the debt and everything, the long-term investing reward will be likely low. So I will put it here. The dividend is something on the negative side of my Quadrant. So Altria, because of the long-term business perspectives, of course it can jump 50% if interest rates go down or something, but that's not the game we are playing as value investors. We are looking for infinite growing businesses. Now, a business that we bought for our YouTube portfolio around 100, that is good. We are now 20% up likely on the position. Of course, when a stock goes higher, the risk is higher and the reward is mathematically lower. The strategy there was that there was risk, of course, but at 1 trillion in market capitalization, when I bought it, I said if it goes lower, we buy more. If it goes higher, we make money, and that was the strategy, and it already worked because I thought that the real value of Amazon is definitely 700 billion, so at that point it was low risk. Now it is a little bit higher risk, but I would put it the risk equal to market risk, given that Amazon is a great business. And perhaps, let's say, the reward a little bit higher, but at these levels, maybe the reward was here when we bought it, now a little bit lower, but still I have to put it a little bit better than the market. Of course, this can change over time. We can discuss it and see how that plays out. Now, another company that we discussed, they paid out a big dividend, and when in Europe a company pays a dividend, there is usually a drop much bigger than the dividend. Okay, 13% dividend of 8-9%, and people just trade around those dividends or like those dividends. I don't get it because it is irrational, but it is a fact that after there is a dividend, nobody's buying it, they prefer to buy it later. Okay, their game. But we discussed it, Africa, oil distribution, so not even risk related to oil prices, likely growth in those countries, Caribbean, Africa, good dividend yield, a little bit higher debt, so the risk is there, let's say even a little bit higher, the reward is also there, so I will put it here somewhere where the reward is a little bit higher than the market, and let's say the risk is equal to the market. Of course, this is in our YouTube portfolio, so it gives a good perspective of what I think. For me personally, there is still a little bit too much of risk, so I'll check it out. If the stock continues to go down, I'm rechecking it because risk is a function of price. The lower the price, mathematically, the lower the risk and the higher the reward. Now, we have discussed Verizon a few times. The dividend yield is high. There is a good correlation with US Treasury interest rates, so you always need 200 basis points more than the Treasury, and therefore the stock went from 58 to the current 35. You get a good dividend, there is a lot of debt, there is a lot of cost of debt, but it is a business that most of you use if you are from the US, for example, and it's likely not going anywhere in the next 5 to 10 years, plus it's growing, plus capex should fall in the future, and therefore the yield is there, maybe there will be some growth even if it is a competitive environment. So definitely a reward, I think, here higher than the market, and the risk, there is really a lot of debt, so reward higher than the market. A lot of that, so riskier than Rio Tinto, not really. Maybe I should put, no, Rio Tinto, just from a cycle perspective, a little bit lower. Verizon, somewhere here, I think. So Rubis, medium risk, higher reward, so we are here for these companies. Now, we discussed Disney. This is 160 billion market cap. I'm just looking at the FTSE and UK companies, of course global companies, but now I'm already going towards the number 100, and market caps are around 6, 7, 8, 10 billion, which are small caps compared to these large businesses, and makes it much more interesting to look for investments. But when it comes to Disney, the business model is in a very, very competitive environment, which means the risk is pretty good there, higher. I don't know whether they will be able to make money, but that is in line with the market, and the reward at 160 billion is, yes, with the best everything. In the past, they could have made 15 billion. But now, given the competitiveness, pricing power and everything, everyone going after their business, I would say it's even a little bit lower here. Of course, again, just my opinion, so ad hoc. Now, we discussed Asos. Look at the craziness in the volatility of this stock. This is down 93% over the last 2 years. And now the question is, will it rebound? It rebounded a few times in the past. We will see if it will rebound again. And that is potential high reward, but also high risk. Okay, someone might take it over, so the risk is very high. But if the risk materializes, the reward is very, very low. And that's value investing. So yes, you can bet. Then if you're looking for bets, I would put Asos here. If you're looking for value investments, then you would put it here. That's a different perspective of the game. Let's put it here, high risk and 50-50, it will rebound, it won't rebound. Because if there are no cash flows, then also the other things they build and everything have little value, the top shop acquisition, etc. That's something that can be costly if it backfires. I don't like these retail, very competitive, highly competitive businesses. A stock that I own in a portfolio that I have accumulated, I think somewhere here. Now it went up a little bit. Maybe if there is a crisis in Europe, it will go lower for more accumulation. But the P ratio is 10, 11. The dividend yield is 5-6%. They have a growth strategy of doing smart acquisitions, very smart acquisitions they have done in the past. So if that continues, you have a 6-7% dividend yield, 5% average growth. When you look at this, the reward is good, let's say high, and given that it has a very niche business, food, I would put it on the lower end of the risk side, which means that there you go. So as I said, this is one that I accumulate depending on what the price. If you want to check that, you can check my research platform. But that's one of the best that I have discussed here. And that's it. I hope you enjoyed this video. We will keep using it. I might delete some of this to keep it cleaner, have something for reference, and then go forward with it. So this is our chart now, and let me know if you enjoy it. Subscribe, check my research platform for more of low risk, high reward investments.